Now, first up, ETFs have become a global phenomenon with as much as $2 trillion around the world in assets under management. Today we are talking to Helena Conradi, Chief Investment Officer at Satrix, around how ETFs are being incorporated in South Africa and what is their role, especially in the retirement savings market. Right, Helena, great to have you with us on Investment 360. And we chat to you often around what's happening with Satrix. We're a market that's still quite small by world standards in terms of the penetration of passively managed products. Just remind our audience, why such a strong case around these funny things called ETFs?
Well, I think probably the strongest case of all is the fact that you address the cost issue. You focus on the client and you address the cost issue, you bring down TER, but not at the expense of performance. So there's also the possibility to actually create alpha, even though you look at the cost, and that is sort of, it's almost a no-brainer. If you have exposure to these kind of instruments in your portfolio, it cuts both ways, cost and performance, you can win.
As you've pointed out, one of the big advantages is obviously fees, but when you look at fees and you look at the average of a general equity unit trust fund at 1.61%, and the average for your Satrix products, for instance, your Satrix Swix and your Satrix Top 40 at 0.45, the 1.2% doesn't sound like a lot, but if you frame it in terms of a real return on or as a percentage of return, how do you sort of have that debate with your clients?
Yeah, the cost you must also think is really on the value add. So the investment itself is the investors. The cost actually comes in that part that you add to the investment return. Now then the cost looks much higher. And then the difference between a 1.6 or a 45 over time, it's compounding. So over time it can make a huge difference. The other thing is also in South Africa, obviously the difference is not as big as in the US. We will get there. The fee pressure is down all the way. But at the moment, probably the differential is not as big as in the US and in Europe. But it's still, in a low return environment, if you can get that, any alpha manager needs to still create that alpha. You already have that in your portfolio, what you save. It's almost a first step to alpha, if you want to see it that way. So
it's almost the lower you can run the fees down, obviously the more return is left over for the client.
Exactly. If you save 1%, an alpha active manager must still create alpha of 1% before you level.
And I mean, we talk about this looking at the long-term return of the All-Share, the JSE All-Share, which has been one of the best performing stock markets in the world, of 15%. We've gone through a period of 5 years now where those returns have fallen to half of that, so 8.5%. So then when you start talking about 1%.
Makes a big difference, yes. Yeah, and the forecast, I mean, we don't know what's going to happen, but still, in a low return environment, low interest rate, any cost, any saving on costs can help you very much.
We're here at the obviously Sanlam Symposium, and Sanlam's been very good at studying what's been happening in the retirement savings market. We still have this problem where we've got too many people not reaching retirement with enough to live on comfortably in their retirement. You know, government wants to take a direction on this, and I just wanted to get to understand your take on where you think especially passive strategies are going in the context of retirement savings in our country.
Yeah, I think the cost paper is still to come, so that is the important one for us as well, but the questions are being asked. Make sure that you get what you pay for. And you don't pay anything more than is necessary. So if you can get exposure to the value premium, for example, we all love value as a style, and you can get that at a cheaper cost through an index, then you should consider it. And I think it's responsible to at least have the investor also to educate him on these different investment options that you have.
One of the challenges I think around this has been that investors take their advice almost entirely from financial advisors. That market still a bit slow to adopt ETFs is my feeling. I wanted to get your understanding of what's going on there.
Yeah, it's a mind shift, definitely, but suddenly people are knocking on our doors. So there's definitely awareness coming into the market, and it's the client. I think it's a sophisticated client asking the good questions. So the financial advisor, he he needs that knowledge, and he needs to know all the options that's available. And the clients are asking tougher questions on cost. What am I paying for the underperformance or the outperformance, hopefully? So definitely the financial advisors are way ahead in terms of, say, the last 2 years, where the knowledge in terms of passive products have been.
Obviously, one of the big things is that it seems to me IFAs have been especially slow in adapting or adopting ETFs, and I wanted to understand, how do we get this product into the market? Because South Africans rely very much on financial advisors for their financial advice. So without that buy-in, obviously the industry is going to be constrained.
Yeah, we've been in the fortunate position that we can offer both. The unit trust, if you think of the fund itself, say for example you track an index like the Dividend Plus, you track whether it's a unit trust or an ETF, exchange traded fund, you track it exactly the same. Same corporate actions, same kind of transactions that you do at a quarterly rebalance. It's the way that you wrap it that's different. So unit trust, it's daily cash flows, you have access to all 40 shares. The ETF, you just package as one share and you list it on the exchange. But it's still access to all 40 shares or all 30 shares in the case of the Dividend Plus index. So underlying exactly the same fund. It's the vehicle type, and it's very much dependent on what the investor wants, whether an ETF or a unit trust is best for him.
How's the take-up been between the two from your perspective, your unique perspective of seeing both in the market?
Yeah, I think it's two different markets. At this moment in time, it looks like exchange-traded funds are very much the direct market, and maybe the institutional market where you have exposure management, quick up in terms of your gold exposure or your resources or your industrial exposure, liquidity that you have in that market, then accessibility on the unit trust side. So financial advisors through LISP, it's easier to invest in a unit trust. So obviously there we see the more of the flows in the unit trust.
So very much the do-it-yourself investors happy to use the ETFs through a stockbroking account or an investment plan,
yeah.
and the unit trust access through the IFA market.
Yes, definitely.
The question we've asked to a number of your peers as well is around, we've had an industry that's been paying commissions to IFAs for their advice. Going forward, if ETFs are already going to become a large force in the market, do you think that the compensation for financial advisors needs to change from commissions to fees perhaps? I
think it's a general trend. So whether I don't think it's only going to be applied to ETFs. If we follow the UK, and financial advisors are definitely already thinking about this. So almost changing their models, their way of thinking, their way that they interact with the client. They are definitely thinking this is going to change. And it will be best for the industry, because then you don't sell that specific product, but you sell the advice, and within that, the product range.
Do you think that's going to, and I know it's probably a little bit out of your field, do you think that's going to, is that going to reduce the number of IFAs that can earn a living from this, or do you have any
question?
Yeah,
no idea.
No idea.
Yeah, no idea. You will probably, I mean, the bigger guys can group together in a way and do this more sensibly, but yeah, no, as you say, out of my field.
So we're obviously going to encourage our viewers to rather pay for the advice rather than commissions. But just to get around this question, Helena, I know you're involved with the debate this morning at the symposium, active versus passive. You say we need to move past that a little bit. There's space for both. What are your sort of advice to investors?
Yeah, I think we waste almost too much time on the debate itself versus, and rather accept there is a place for both. Both of us, in terms of active or passive, we can give you a case why it should be part of your portfolio. And for me, the important part is really to spend some time with your client. No solution is unique. So rather spend time with him, understanding his objectives and his requirements, and then work on a solution, whether it's active or passive. So whether you expose yourself through an active fund or a passive fund to, say, for example, the value style, that's a secondary question. First, really understand the objectives of the client.
We've got a few developments. We've seen some of your competitors launching, I guess you call it a blended ETF, which is like a balanced ETF, for want of a better way of describing it. Very, very similar to a balanced fund. again today, iTransact launching their retirement annuity. Is that the next big frontier for ETFs?
I think so. There's either you provide the building blocks so that the financial advisor can put together his own balance fund, or you give him, some of them prefer, and we've had huge demand on that, is you give him the balance fund where you actually put together the building blocks, and we can put together a smarter core for that matter. But yeah, there's been huge demand on both sides. So building blocks as well as the portfolio itself, the balance fund, the total solution.
And that obviously that you believe will unlock the ability then for clients to actually put money as part of their retirement savings into these products.
Yes. Yeah, that provide exactly the low cost vehicle that Treasury is pushing as well. So we didn't want to mix it either, because you can now say you want tactical asset allocation or strategic. We wanted to give a pure low-cost vehicle on the balance side. So we've decided to go for that.